Welcome back. Continuing with our corporate conversation, Chalet Hotels is the next management on the show after a good second quarter results. Hotel additions, renovations and annuity business aided the growth, but the bottom line was impacted by higher tax expenses. We have Sanjay Sethi, who is the managing director and CEO of the company, joining us. Mr. Sethi, good afternoon. Thank you so much for joining in. What's been your average room rate this quarter and what are you expecting to end the year with?
Good afternoon and pleasure being back on CNBC-TV18. Look, we've grown in Q2, the rates grew by roughly around 10% for the portfolio, and the RevPAR grew at approximately the same rate, which means that the occupancies were consistent with what we did last year. We don't speak about forward-looking numbers, but the RevPAR growth in double digit is pretty much on the onwell going forward for the hotel industry in general.
Absolutely. The RevPAR growth is visible. And, last year wasn't a feeble base as well. We had a fair amount of occupancy by virtue of the G20 summit, not necessarily at your properties, but because of, a lot of them being at all other properties. Every other hotel also did see increase in occupancy. So maintaining that itself is a good thing. We've seen that in a lot of the other numbers too. Increasingly, where do you see margins stabilizing for this industry? Because on the one hand, RevPAR is increasing, but on the other, costs are also increasing. 32% margins is what a lot of the hotel companies on a mature basis are making. Do you see further upside from here on as new assets come in, as RevPAR increases, but at the same time costs increase too?
So every, hotel is sensitive to its location, and, the rates can be very different in each city, and therefore margins do get impacted. Chalet has been consistently delivering 40+% EBITDA margins, and H2 typically is much better than H1, and we expect to deliver robust margins going forward. As an industry, it's very difficult to generalize, but I think the costs, whilst they were growing a little while back, they seem to be under control, and I think Chalet's results reflect that. The demand-supply arbitrage is favorable for the industry. It's going to be favorable for the foreseeable future, which is the next 2 or 3 years. And the inflation seems to be fairly under control. So revenue growth is clearly surpassing cost growth.
Mr. Sethi, you've added some new properties recently, one in Pune, the other one being in Hyderabad. You're adding some more rooms at the Bangalore Marriott as well. When do they break even, and what is the expected additional revenue addition that you're expecting from these properties?
So, Hyderabad's been in place since June of last year. So this is actually the first quarter that we reported like-to-like for Hyderabad. And we've seen that growth come in despite that. The Duke's Retreat, which has been shut down for renovation, expansion, and repositioning, has been out of the system for almost a year now. And therefore, these results that we speak about are despite that shutdown. Bangalore, we will add 130 rooms by end of this calendar year. And therefore, we expect this 130 rooms at a RevPAR maybe of about 7,000-8,000 rupees getting added to the P&L going forward. But these are all incremental rooms in Bangalore, which means our fixed costs are already covered. Therefore, we expect margins to be significantly high with this room addition that we'll do in Bangalore. Duke's Retreat will come into play by end of the financial year with about 146 rooms, but on a monthly basis, we are opening out inventory. So we are currently at only 37 rooms which are operational. By December, we'll be at about 73 rooms, and by January, hopefully around 100-room mark. These new additions, in addition to the pipeline that we're developing, which is the hotel at the airport in Delhi, right. The Hyatt Regency in Airoli, Navi Mumbai, and our recently announced acquisition of the land parcel in Varka in Goa is going to be the pipeline going forward.
One is very excited for the Varka property as and when it comes on stream. I believe it's a couple of years from here on since you've just acquired the property. One final question before we let you go. I remember when we earlier spoke, your annuity business was about 100 crore sort of run rate on an annual basis. Now it's jumped all the way up to 160, 170 odd crores. Where does this number go over the next few years? If you could give us a sense on that. And secondly, because of the fundraise that you've done, your debt has come down significantly to close to around 1,600 odd crores. Where does that stabilize going forward as well? So these two questions.
Sure. So to address the debt part first, we are a high growth company and we are in the capital intensive side of the business here. So we will see some increase in growth. We expect debt to sort of stabilize around the 1,850, 1,900 number with the announced projects that we have in place. In terms of your sorry, I forget your first question. Could we come back to that again?
The first question was on the annuity business, the run rate.
Yes, so that's something which we have 2.4 million square foot of office space that's ready now for leasing out. Out of that, around 65% is leased out now, leased plus LOIs in place. So there will be incremental and exponential growth for the next few quarters on the annuity side of the business till we stabilize the office occupancies in the 90% mark and above. We do expect a serious sort of flow through from the office assets because they tend to throw up high EBITDA margins, and we expect EBITDA margins to be the range of about 84-85% in the office segment of the business. In addition to that, we've got the one residential project in our play. That's trading extremely well, better than we expected. Last quarter, we sold 32 apartments, north of 21,000 price point.
All right, Mr. Sethi, thank you so much for sparing time. Wish you good luck for the rest of the financial year as well, the management of Chalet Hotels. A small programming note as we slip into a short break. As we prepare to ring in the festivities this Diwali, tune in to CNBC TV18 at 3 p.m. on the 29th of this month to hear out some of the biggest market voices giving their tips on how you can make your portfolio prosper this Diwali.